Well, Nagendra Rana here. The topic of the day is profitability of general insurers in India. Profitability of general insurers in India. The profitability of general insurers in India in 2024 says that the company's consolidated net profit of GIC increased by 43.27% in the June 2024. As far as the position of state-owned general insurers is concerned, the financial performance of these companies improved significantly in 2024 because Oriental Insurance earned a profit of rupees 18 crore in 2024 compared to a loss of rupees 5,000 crore in 2023. While the National Insurance Company narrowed its loss to rupees 187 crore in 2024 compared to rupees 3,800 crore in 2023. While United India Insurance narrowed its loss to rupees 800 crore in 2024 compared to rupees 2,800 crore in 2023. New India Assurance has increased its profit from rupees 1,000 crore in 2023 to rupees 1,100 crore in 2024. Sir, as far as industry growth is concerned, the general insurance industry grew by 12.78% in 2024. The gross direct premium income, that is GDP of the industry, increased by 15.5% year on year in 2024 to rupees 2.79 trillion. So the health segment saw the strongest growth, accounting for about 50% of the incremental GDP. 50% of the incremental GDPI. ICR expects that GDPI to remain strong in 2025 and 2026, reaching rupees 3.67 to 3.71 trillion by 2026. So as far as India's insurance premium is concerned, this is increasing every year because India's share in global insurance is going up every year, and India is leading insurance market as on date, which is improving its position every year. But still the profitability is a matter of concern because growth and profitability both are required for a healthy development of the insurance industry. Now the General Insurance Corporation of India is about to sell its stakes. So the profitability of private insurers is likely to improve, supported by better underwriting performance. The combined ratio for PSU insurers, though expected to be lower, will remain weak, thereby impacting net profitability. Moreover, the capital requirement of these three PSU general insurers, excluding New India, is estimated at a sizable rupees 94 to 102 billion to meet solvency of 1.50 as of March 2025 assuming 100% forbearance on the fair value change account. So ICRA expects the general insurance industry's GDPI to touch rupees 3.7 trillion by 2026. FY 2026. So a robust 32% rise from rupees 2.8 trillion in financial year 2024. While the growth for private insurers is expected to remain strong, that of PSU insurers is likely to remain moderate because of the weak capital position. The profitability for private insurers is likely to improve, supported by better underwriting performance. The combined ratio for PSU insurers, though expected to be lower, will remain weak, thereby impacting the net profitability. Moreover, the capital requirement of 3 PSU general insurers, excluding New India, is estimated at a sizable rupees 94 to 102 billion to meet solvency of 1.50, assuming 100% forbearance on the fair value change account. So with higher growth, the market share of private insurers in terms of GDPI is likely to rise to 69% for financial year 2025 and 71% for financial year 2026 from 68% for financial year 2024. So the health segment, which witnessed the strongest growth, accounting for 50% of incremental GDPI of rupees 375 billion in financial year 2024, is likely to remain the key driver with the rising awareness of health insurance as well as increased ticket sizes. The industry's GDPI saw a robust 15.5% year-on-year expansion in financial year 2024, rising to rupees 2.79 trillion, supported by the health segment. So apart from this, the growth in the motor segment was healthy, supported by the increase in new vehicle sales. Two-wheeler rose by 13.3% on year-on-year, and passenger vehicles or PVs by 8.4% year-on-year on FY 2024. Now, with the high frequency and severity of natural catastrophe, that is net cat event in FY 2024, the net loss ratio of the fire segment was impacted. However, considering the reinsurance and low retention in this segment, the impact on the overall net loss ratio of the industry was manageable. So profitability for private players remained strong, supported by improved investment income, which is likely to continue. So ROE for select private players in ICRA's sample set companies is expected to improve to 13.3% in financial year 2025 as the underwriting performance improves, combined ratio of 106% in financial year 2025 over 107% in financial year 2024. So the PSU insurers posted a small net profit in 9 months for FY 2024 in contrast to the net losses in the previous years, driven by improvement in the combined ratio, supported by the absence of the retrospective wage revision and payment of associated arrears in FY 2024, and higher investment income. So ICRA expects the combined ratio for PSU insurers to remain weak, albeit improving at 121% in financial year 2025, 122% estimated in financial year 2024. So solvency ratio for three PSU insurers excluding India remains weak at negative 0.58, excluding the fair value change account of on investment as of December 2023 in relation to the regulatory requirement of 1.50, resulting in a sizable capital requirement. The private players, however, remain comfortably capitalized to meet this strong growth. ICR estimates that the capital requirement of the 3 PSU to be sizable at rupees 94 to 102 billions to meet the solvency of 1.50 as of March 2025. Assuming the inclusion of 100% on FBCA in the available solvency margin, excluding this, the capital requirement would be highest at rupees 320 to 328 billion. Some of the major investments and developments in the Indian insurance sectors were made in the 2024. When in April 2024, CCI has approved Axis Bank Limited's subscription to 14 crore 25 lakh 79,161 equity shares of Max Life Insurance Company Limited. That relates to the life insurance sector. So the market share of private sector companies in the non-life insurance market rose from 15% in financial year 24. Private insurers like HDFC, ICICI and SBI have been some tough competitors for providing non-life products to the insurance sector in India. The market is of course growing very strongly, and India's general insurance sector is projected to grow very fast. In the sense, the general insurance market in India is forecasted to grow substantially, achieving a gross written premium of INR 4.89 trillion, that is $57.3 billion by 2028. So marking a significant increase from Indian national rupees 3.35 trillion, that is $40.36 billion in 2024. This represents a compound annual growth rate of 9.9%. So projection for 2024 indicate an 11.2% rise in the sector, largely propelled by key insurance lines such as personal accident and health, motor and property, which together comprise 93% of all general insurance premiums in 23-24. Now, the general insurance industry in India continued its high growth trends, driven by economic growth and rising disposable income, rising consumer awareness of health and other general insurance products, and robust regulatory reforms also supported India's general insurance industry growth. So the trend is expected to continue in 24 and 25 and onward. So further supporting the industry, the IRDA has greenlit the introduction of Bima Sugam, an insurance electronic marketplace, which launched in March 2024. This initiative aims to streamline the process of purchasing, selling, servicing insurance policies and handling claims and grievances, promoting greater efficiency and transparency across the insurance landscape. So the sector is expected to see a CAGR of 7.9% over the next 4 years, partly spurred by the new vehicle scrapping policy that mandates the scrapping of private vehicles older than 20 years and commercial vehicles over 15 years old. Property insurance is forecasted to represent 22.5% of the gross written premium in 2024 with an expected annual growth of 10.4%. This segment is bolstered by an 11.1% year-on-year increase in governmental infrastructure spending, which totals $134 billion for the fiscal year 24-25. So recovery in the economy and rising disposable income will continue to support the growth of India's general insurance industry during the next 5 years. Initiatives from the government and favorable regulatory reforms will help in increasing the insurance penetration rate in India. That is 0.98%, which was lower as compared to other Asian markets such as Japan 1.75%, South Korea 1.46%, Hong Kong 1.65% and China 1.26% in 23. Thank you very much.